The Nifty closed this week positive, and we saw this bounce into the last week of the financial year, which is very much typical, and it was mostly driven by small caps. So you ended up seeing the bank Nifty and the mid cap, small cap indices make a new high above the high that the Nifty made, which is 9222 mid month. The Nifty and Sensex itself did not end up making a new high. So I think that was an interesting intermarket divergence, and we'll be watching whether that continues to hold out. My sense is that you should probably ideally get a correction first before you continue to new highs if you have to, and we'll have to watch whether the correction ends up becoming a larger reversal or not. So that's what we'll be watching out for in the near term. But having said that, we also saw the first down month after 4 months of a rally in the US markets, and that coincided with a month in which the dollar was actually down and gold was actually up. And I would have expected that falling dollar would have impacted the US market negatively, which it did this month, but it did not do so in the previous month when that was happening. And so the dollar and gold have actually been moving in that direction for 2 months. And the only reason I think that didn't happen is that the bond market, which I thought would have bottomed in Jan, only ended up bottoming this month, which is in March, making a double bottom and then actually rallying. And the interim period made a triangle, which is essentially a fourth wave scenario. So that usually means that this is the last move down. And so I think the bond market sell-off, which started in June of 2016, should have actually ended by now. So I think that's my primary opinion, and I've been discussing these four asset markets: equities, bonds, gold, dollar, for quite a while. I think several months, and I made it a point to spend more time on various investment modes with gold in my December long short report. But since then, my daily write-ups have been talking about these four asset classes on a consistent basis, essentially because I was expecting this big asset inversion, which is when the dollar starts falling, you'll get a commodity rally, you'll see inflation, and you'll at some point of time, when the bond market bounces back, see US equities also sell off while the dollar is falling. So the second part did not happen till this month itself. In Jan, they were still going the other way, simply because I think I got the bottom in the bond market early, and it made this double bottom now, and I think now it should be done, and you should see that view play out more accurately now in the next month or so. But what is important here, and I got an interesting email on this, and so I should highlight, is what is going to be the next big trigger for a major market turn down whenever it happens. And my answer to that is it probably end up being the bond market itself, because if you think about what's the next big bubble, it's probably the bond market. The bond market can be the source of the next global bubble, and it's probably popped in June of 2016 because that was an extreme in sentiment, and we've also seen a five-wave decline in the bond market since then. So it's probably already popped. So why hasn't it really affected most other asset markets? And the simple answer to that is most people would not recall that the housing bubble itself popped in 2006, not in 2009, when you actually had the biggest part of the sell-off or crash in equity markets. In fact, 2008, the second half was where you had the commodity crash. So what happened in that time period is that I was in the US in 2007 May, and you already had a lot of subprime houses, small houses that had been built around the outskirts of various parts of the country, and prices had started to cool off. A lot of loan defaults had already started to pick up, but nobody really thought the problem would become too big. And then you had bear turns happen in June and July of that year, and then bear turns when the company shut down and there was some bailout money put up front. The US markets again rallied to a new high into October of 2007. It's only after that that the market peaked. But it was not much later, much later, and several months later, that you actually saw so many other corporations fail because of what is now known as the housing bubble. So it takes time for these things to manifest. So while the bond market bubble might have already peaked in June of 2016 based on the bond market price action, sentiment, and so on, and you've seen the first big sell-off, now you're getting a rebound in the bond market that could last for a month or two. It's only when the next big sell-off in bond markets occurs, I think, is when it will get more notice than it got this time. It will be hard to not notice, and whenever that happens, once this counter trend move is done, because you don't know how long time wise it can take, is when you'd probably see the impact of the bond market bubble having popped already would have on various other asset classes. And in the interim, I think you are going to see a continuation, I think, of the trend that we've already seen, which is a falling dollar. The next few weeks, we should see whether a bounce back in the dollar can hold, because it was an important support, and so far we've fallen in three waves. So you can argue both ways for the dollar. You can also argue that it's bottom and going to go higher. But I would like to see that it holds off at some kind of a resistance, maybe close to 101. And if it doesn't go beyond that significantly, then the next sell-off would make those trends pretty much more apparent, and then you probably see the trend in inflation and rising commodities actually continue. And like you saw in 2007-8, there was a huge lead lag between various emerging markets peaking compared to the US. You'd probably see that kind of a lead lag this time as well, because you'd get those. There's some emerging markets that might actually get support from the falling dollar. Like we are seeing last month, it led to one of the biggest inflows in terms of money being put into emerging market ETFs. So these are trends that could continue for a while till the real issues surface, and that can take several months. But some of these trends are already in force, and therefore should not go unnoticed. And therefore, in hindsight, you'd probably spot the bond market bubble as having peaked in 2016, even though equities continue to move much higher into 2017. So that's all in this update from me. We'll be watching the 9222 mark for the coming week and whether it holds out for the Nifty as well. Thank you.